Joe Brusuelas is here, chief economist at RSM, as we've gotten a lot of economic news and we're upon a couple of very big deadlines too. How are you feeling in the big picture here?
Well, the economy's doing okay. We got a dynamic and resilient economy, which is good because via the trade channel and immigration, we're getting some stress that's put on the economy. So it's slowing. We could see that in the data, especially in consumption. So it's sort of what we're watching right now. But we've entered the silly season here in financial markets. We've got the big jobs report this week, and not really a lot else going on other than the political circus in Washington.
Yeah, and look, we have the big, beautiful bill.
Yep.
We have the tariffs deadline. Could those be major market-moving events?
I don't think so, simply because one, it appears that the Trump administration is getting ready to do another 90-day extension. So I'm not expecting anything major to happen there. Second, we'll see how the Senate addresses the differences inside the GOP, and if that reshapes the end game around one big beautiful bill. I'm not necessarily concerned around what's going on in the Senate, but when they pass their final version of legislation, going back and negotiating with the hardliners in the House, now that's going to be a little bit more interesting. So in another week or so, perhaps we might get some impact on the market, because as I look at equities, I look at valuations, it does seem that a pretty significant tax cut has been priced in to the value of these stocks.
Folks are betting on that.
And if it looks like this might not happen or be delayed, then we could see a pullback.
Yeah, that's what we were hearing from our Schwab team too. The big, beautiful bill continues the tax cuts from Trump 1.0.
That's right.
Then Biden continued it, so this continues it again, and people got very comfortable with that. And if they don't have it, they may, obviously not be very happy with that.
And there are a lot of other actual features in the bill, such as, permanent expensing on business investment, which I think is a great idea and should be made permanent. Now, if this doesn't happen, that's going to take a little bit out of the Mag 7 stocks, because the tech's one of the big beneficiaries of the one big beautiful bill.
Let's talk about the big picture here. We've gotten in some manufacturing data today. Alex Coffey was giving us that, coming in lower than expected. I saw some construction spending, not so great, it had negative numbers. The slowing is evident, but you don't see a recession.
No.
You never, every time you come on, you say no recession.
No recession.
We
have a 40% probability over the next 12 months. That's elevated. I don't like where that's at.
Right.
But I just don't see it. We're more likely to grind down to around 1% growth or less. That will then warrant probably rate cuts, maybe later this year, definitely next year. But I just don't see it right now. We escaped, the real risk around the 12-day war and oil shock. That could have been the big differentiator between a continuation of the business cycle or a premature end. But for now, that all looks good. So no, I don't. But we're not going to see the 3 to 4% growth we got used to over the past 3 years. That now is off the table. We're thinking more around 1.8%, which is the long-term growth trend.
I hear you say the 12-day war, and I just can't believe sort of what we just went through.
That's right.
And I think about the my kids, and I mean, that could have escalated so much. And the fact that people sort of, took it like, all right, it's going to be the ceasefire, it's going to end, and markets move to new highs. Of course, markets often move on highs when you have wars, but it's pretty amazing, the 12-day war. Let's talk about jobs, the job picture. Look, we've had fewer jobs added, but enough. When you talk about what kind of jobs are being added, what within the jobs report stands out to you?
All right, so the number of the day is 100,000. That's the minimum we need to keep employment conditions stable. That's actually our forecast for the month of June. We do see job creation slowing, and specifically we're beginning to pick up some of the detail around trade-sensitive areas of the economy. We're watching that. Inside the ISM this morning, you saw prices paid continue to rise. So right now, what my sense is there's not a lot of firings going on, but hiring slowed. We're at 4.2% unemployment. I think it's going to move up to 4.3. we're at full employment. You and I have been having this discussion now for a couple of years. This is a very good place to be, but we know a lot less about what the economy looks like at full employment than we'll ever readily admit. I think that, hey, look, why would firms be bringing on a lot more workers when demand is slowing, right? Consumption only increased 0.5% through May. So we're definitely seeing that slowing that we thought would occur on the other side of the policy shocks that the administration's unleashed.
Yeah, you said the Fed, I think you're sort of wary whether or not the Fed's cutting this year. You don't really think the Fed's rushing to cut
No,
this year?
they're not, nor should they be.
And then next year cuts?
Yeah, we'll get some cuts just simply because I think that, as inflation rises, demand slows. You're going to get those little fissures in the jobs market probably will begin to look like cracks, and the Fed will want to get there, I think. When we run our models, which estimate the central bank's reaction function, right? The optimal interest rate right now I get is 4.55. The rate right now is in a range between 4.25 and 4.5.
Yeah.
That means monetary policy is pretty well suited to where we're at with current conditions. The big deal, though, is what's going to happen to PCE inflation and core PCE. Those did rise last week on a year-over-year basis, and we haven't even seen the impact of the tariffs yet. We thought that would really begin to show up in the June data, but it's the July data we'll get in August where you're really going to, I think, see it. And then we'll have a much more pronounced discussion ahead of that Fed meeting in September on whether the Fed should cut or not.
There's so much talk about the tariff spike for inflation, and we're just not quite seeing it yet. We may or we may not.
Or should we? I mean, they only implemented this in April, and most of the data we've seen is only through mid to late May.
And a lot of it has been paused, too.
That's right.
And we've seen prices going up in anticipation of the tariffs. I mean, when you go to the retail stores and things, but not necessarily seeing the tariffs go up. When we talk about the rates, normalization of rates, real rates, you said you don't expect rate cuts really more till 2026.
I think one this year now.
One this year? Okay.
Unless the economy cracks. Then we'll get 3. Our colleagues over at Goldman yesterday said they expect September, October, December. It was an interesting call. I always pay close attention to what Jan and his group forecast. They think this economy is going to slow a little bit more than I do at this point.
Right.
So I understand the rationale. I need to see that labor market crack before I'm confident that we're going to see the Fed move more aggressively this year.
I had a guest on yesterday who has a year-end target of 6,600, and it had been 7,000. And the reason he brought it down was for one reason, and that was about corporate tax rates. He thought that corporate tax rates may come down, and that's why he had the 7,000. Now we're not really seeing that sort of advantage in the big, beautiful bill. And so for that reason, he brought it down to 6,600. He didn't say slowing economy or facing costs or things like that. He said it's just a less favorable tax environment for corporations, so he brought it down, but still sees new highs.
I think that there's a disconnect right now between what's going on in the real economy and the stock market. Don't get me wrong, I love the big number.
Yeah, let's hear it.
But it's like that cool F1 movie that's out right now.
I can't wait to see it.
There's you have to really have a willing suspension of disbelief to truly enjoy it. And some of these stock valuations are stretched a little bit thin given the risks that are hanging over the real economy right now. But nevertheless, it's July 1st. It's our silly season here on Wall Street. Volume's thin. People are going on vacation.
And July is a good month. We haven't had a negative July since 2014.
And we're not going to this July either, right?
Okay.
It doesn't look that way. Right.
Thank you. Joe Brusuelas of RSM. Thank you so much.
Thank you.
Good to see you.